Question on moving my 401k to a traditional IRA when I retire and leave my job. Today, we got a situation from someone who has questions around their 401k. Let's see what they're dealing with and see how we can help them. Me answering this question does not establish a client-advisor relationship, and this is just for information purposes only. This person says they're retiring at 59 plus. Basically, my question is concerning losses in the 401k. People say it's only a loss if you sell, but when I go to retire, if the market is still down, is that going to be a loss? In other words, will my company hand me a check for the value of my 401k? And when I open an IRA for it, do I lose that quote unquote potential recovery? And can I take those existing funds with me and get the growth back? A lot of people really don't know how to handle their 401k when they retire. Many of us pretty much just signed up for our 401k when we got hired. We know that the company put some money in. We know that we put some money in, but we really don't manage it. We just think, well, retirement is 20 years from now. I'm just going to set it and forget it. I can't take anything out because I heard you shouldn't do that before 59 and a half anyway. Now, this person said they're 59 plus. Now, that's the first thing that I recognize. 59 plus does not mean that you could take the money out if you want to. It's 59 and a half, not 59.7, not 59.6, not even 59.4444. It needs to be 59 and a half. Okay. That's the first thing. Now let's break down that second part. What is technically a loss? Many of us has heard that term. You don't lose until you sell. Well, technically that's right, but it's kind of not right as well either. You are losing, but you're not losing the physical stock. So if you own a stock that's $20 per share, if it goes down to 15, you're not losing that stock. What you're losing is the value in that stock. If inflation is 4%, you're not losing that dollar. You still have the dollar in your hand. You're losing 4% of your purchasing power. So the value of that dollar goes down, meaning what you can do with it goes down. Same thing with your stock. If your stock is at 20, and now it's at 15, you lose $5 of what the value of that stock is. Now, when you're talking about locking in those losses, when you sell it, you don't have the potential for growth. Once again, the stock itself is a fluctuating asset. That means it's going to grow and appreciate, and it can also depreciate. So what you can gain is in the value of that stock, not the stock itself. You will always own that stock until you sell it. Now, once you sell it, you lock in the value of what that stock is. If the market's down when they go and sell, does that lock in his losses? Well, it depends if it's even a loss at all. Many of us have been contributing to our 401k for 10 and 20 years, and the value of those assets as they appreciate probably far outweigh our contributions into it. For example, if you have a $2 million IRA, but you've only contributed $500,000, and let's say the market comes down and it goes down to 1.8, that's still a win. You are still gaining in that account. You technically haven't had a loss. A lot of people suffer from what they call the endowment effect. And the endowment effect is a behavioral finance term that says that we perceive more value when things are in our hands. So when we receive that statement at $2 million, we automatically lock that in and say, that's ours. We have $2 million and no one should take it away from you. Now, when the market corrects itself, maybe by 10% or so, we lose that 200,000 and we go, oh, we've lost so much and it's crazy and I just can't take this. And oh my gosh, the world is coming to an end. Not knowing that you've only contributed 500,000 and you're up $1.3 million at that point. And that's what we do as financial advisors, help you see that because you did the right work, because you made the contributions, you're actually winning, even if the market 5, 10, 15 years down the line has pulled back a little bit when you go to transfer your IRA. So we're not thinking about what you could have had because the market could have went the opposite direction. The market is going to be the market, and we are going to adjust how we live and how we participate based on the market, not trying to control the market. So the next part of the question, they're wondering, is their company going to hand them a check for the value of their 401k? And when they open up an IRA for it, do they lose the potential recovery? So that is a very great point. So yes, your company is going to sell off the stocks in their 401k and they are going to send you a check. Now, this is a very important part. You need to make sure you do this in the proper steps, or you may risk a huge tax liability if you miss this part. When you leave your company or when you retire, you need to do something with your 401k. You have a couple of options. You can keep it there, but benefits of actually keeping it there, which is the employer benefits of them paying some of the management fees, them making matches and contributions, your ability to loan on that money, those benefits are gone. So you can keep it there if you want to, but I don't know why you would. If you don't do the right type of rollover, there's two types. There's an indirect and a direct rollover. You may be facing some tax liabilities if you hold on to that check too long. If it goes over 60 days and that check is not deposited into an IRA, then the government is going to assume that you withdrew the money and they're going to tax you appropriately, meaning that you may find yourself in a 37% tax bracket paying taxes on $2 million in 1 year. Now, when you roll over your 401k into the account, is going to be in cash. It's not going to be in the stocks that it used to be. That is another major mistake that many investors make. They get the check, they deposit into an IRA, and they expect it to grow just like it grew in their 401k. But what they fail to realize is that you were invested in something, whether it was a mutual fund, like a target date fund, or maybe an index or an ETF, or maybe even simple equities of your company. Those assets, that money was invested into something. When you roll it into an IRA, you need to invest it into something. That's why you need to make that decision with a financial advisor. So you are not more aggressive than you need to be, or you're not more conservative than you need to be. Finding the right investments for you. Can I take those existing funds with me and get the growth back? Well, yes, you can try to work and get those growth backs, but once again, you're chasing the market. So if the market went up 5% when you transferred the assets, you're going to be chasing that 5% forever because you can't make it back. And in your head, you can say, well, if I make 10%, I made back my 5. You can play those games if you want to, but once they're gone, they're gone. So this is a very, very good question. Rolling over your 401k can be very complicated and very sensitive. Many of us lose the support of our jobs when we are deciding to roll over our 401k. Many of us get so overwhelmed, we end up leaving it at our job. And then when we need our 401k or distributions, or we need some form of income, we have to jump through so many hoops. And because we are stressed and overwhelmed, we make bad financial decisions. And that can cause us to lose almost 4 out of every 10 years that we work. Because if you're under 59 and a half, there's going to be a 10% early withdrawal penalty. So on $2 million, that's $200,000 you lose right off the bat. And it's going to put you into the highest tax bracket, which is around 37%. So you're looking at 47% at a minimum that you're going to have to pay in taxes because you made one bad financial decision. But I don't want that to be you. If you need help rolling over your 401k or deciding what to do with your retirement, you can click the link in the description and apply for retirement planning consultation. We'll walk you through the 401k, go over some of your options and what you can do. Let's recap what this individual can do. 1, congratulations on your retirement. 2, you did the right thing by opening up a qualified account, an IRA. Now you're going to want to do a type of rollover. If you need some cash, you can do an indirect rollover, but that does have a time restriction. So be very cautious of those deadlines of when you need to put the remaining of those funds into an IRA. You could do a direct rollover where you don't have to worry about the tax liability, the trustee transfer. Make sure those assets go from your old employer to your IRA. Next, you're going to make sure that you invest in something. You don't want to sit in cash for the next 4 or 5 years and wonder why you haven't made a penny and wish that you would have reinvested into your 401k because the IRA is a quote unquote scam. It's not a scam. You just haven't taken the next steps. And finally, make sure that you subscribe and reach out to me if you don't want to do this by yourself. And you don't have to. You can hire a financial advisor, get this process started, and help you manage your IRA and manage your 401k the best way possible. My name is AB Ridgeway, and this is another Ridgeway Report.